Hi, everyone.
We hear you, but we
Yeah.
don't see you. Is that? Oh, now we
You
see
don't see
you.
me. You do see me. Do
Yeah,
you see me? I might have a little bit unstable internet connection since I'm in an Airbnb right now, but I'll hope it works with presenting. So yeah, thanks for having me on. I'm Felix from Chorus One, currently the #1 validator actually on Solana. And yeah, I'm super happy to be invited here to you. Thank you for inviting me, and hello everyone that's there. I have a little bit of slides, so actually I'm going to talk about liquid staking with Lido on Solana, and maybe kind of try to give a little bit of an overview of staking in general, and then the product that Lido is doing. And then there's a lot of room for questions since I didn't like prepare like a huge slideshow or something. So
yeah. Felix,
how
if
does
you
it
could
look?
also explain what is Lido, because this is very also innovative concept, and I
Yeah,
like that
yeah,
very
for
much.
sure. I'll try to like kind of lead towards that in the slides. So I'll have some slides.
Amazing.
I'll just share my screen. I hope it'll hold up based on the internet. Let's see how is it looking. Do you see my
It's
screen?
good. It's good. Yeah, it's good. And if not, just share the link with me and I'll share from my computer.
Okay, perfect. Yeah, let me know if it kind of breaks up or something. So yeah, today I titled this Staking Meets DeFi. So that's kind of the core of liquid staking, how I see it. To start, I just wanted to like introduce myself. So I'm Felix. I'm currently the Chief Commercial Officer at Chorus One. So I basically lead our strategy in terms of what networks to onboard, what initiatives to follow, our BD, kind of who we are working with, who is staking with us, and the research part, like again, which networks to onboard. I also write a newsletter with Robert, who was also on here today, I think earlier.
Yeah.
So stakingeconomy.substack.com for those that want to check that out. So that's coming out every month if we have the time, which in the last few months wasn't that often, but we try to write like industry commentary from basically the front line since we all run validated companies. So it's also with Chainflow, Chris and Robert from staking facilities. So we try to like report basically what is happening on these different proof of stake networks from our perspective, who we are really close to the action, let's say. And that's also like where I'm from, right? Like the company I represent, Chorus One. We're a staking provider on over 25 decentralized networks. We originally started out in the Cosmos ecosystem, but very early also found Solana and found it very interesting, and have been like one of the kind of Genesis validators there, and like have been supporting the team for a long time. And more recently also started building a product kind of for Solana staking specifically that I'm going to talk about a little bit. But we're also on other networks, including Ethereum 2, Polkadot, Cosmos, and yeah, over 25 others. Currently securing 4 billion in assets. That's a lot. Solana too, since Solana has seen a big run up, and we're the biggest validators, as I said, there right now. But we're also on a lot of other networks, and over the time we exist, so since 2018, we've been paying out essentially staking rewards over $100 million worth. So for those maybe that not that familiar with staking, right? You stake your tokens, you help secure the network, and you will receive basically some inflationary rewards or transaction fee rewards from the protocol for doing the job of like putting up your capital. And we basically facilitate that by running the node infrastructure and helping, especially also like maybe more institutional holders doing that on different networks, and kind of do that in a secure manner without going down or getting slashed. So if you want to learn more about Chorus One, you can go to the website here, chorus.one. But yeah, today I kind of wanted to just kind of talk about liquid staking. So basically the normal idea of staking is, right, you take the tokens, you lock them up maybe for like we just discussed, I guess, longer time. Could be just 3 days in Solana. It just takes 3 days to unstake. In Cosmos might be 21 days, and other networks can be a very long time. And then you kind of choose this validator. So this is like a screenshot from Block Explorer, also Solana Beach actually, where you can see the different Solana validators and kind of their stake, how it kind of goes between them. So you can see there's definitely a bunch of bigger validators, including us, and maybe also staking facilities that have like a lot of stake, and then it goes like slower and lower down, which sometimes also can be seen as bad, right? Like you have a bunch of the big validators controlling a lot of the stake. because they were maybe early, they know, have better connections to the early holders, or there's a lot of factors at play here. Also, often people are very lazy and just pick from the top of the list, and then maybe the other validators don't get a chance. So people are not like putting so much research into validator. For a lot of people that just hold the token, it's also like, what am I looking at here? It will just click, you know. And that's kind of where liquid staking comes in. So liquid staking has like two effects basically. So the one side is that the thing we mentioned, right? You have these lockups. So often that's very kind of, there's a constraint, right? If you lock your tokens, maybe you want to withdraw because you want to sell, but now you can't do it. So that's obviously for the user kind of a bad user experience, and you might want to be able to exit your staking position at any time. So basically, this is the liquidity argument that liquid staking allows. So basically what liquid staking does, which I'm going to talk about a little bit more in the next slide, is that instead of directly like staking with a validator and through the protocol, you're essentially putting your assets into a pool, and that pool is essentially more or less staking on your behalf and issues you kind of a token that represents your staking position in that pool. So like you're part of that pool, which then basically allows that pool, let's just call it pool, allows the pool to take over all the staking logic. So it will basically choose the validators based on maybe some algorithm or some other decision-making criteria. It can stake with multiple validators. It can handle the liquidity in some way. And for the user, right, it's like a very simple experience, because now what you're doing is just clicking one button like stake, instead of like having to choose the validator, having to know about all these other concepts. And then in addition to that, you also get the ability to use the tokens, the staking tokens that you staked in DeFi. So that's probably the biggest part, since like usually if you would stake, you would not have access to your tokens anymore. And that's like on Solana right now, I guess that's probably more than 10 billion, right? In terms of like what's staked. Actually, I should probably know this better, but it's billions of dollars that would otherwise sit idle, essentially. Like they are securing the protocol and earning rewards, but you can like bootstrap the kind of DeFi ecosystem which is emerging. So if these DeFi protocols would have access to the stake tokens in that manner, they could maybe like, you know, offer better rates and allow more people to participate and kind of grow quicker. So this is like a big reason why these liquid staking tokens now exist, since there's like kind of a clear user demand for people that want to participate in DeFi, that have the staking tokens, but actually still want to earn the yields from staking, but also want to participate in DeFi. So this is like just a quick overview of how Lido for Solana works. So basically Lido is a liquid staking protocol for Solana. So Lido is also on Ethereum, and it allows, again, the steps before. It kind of issues your representational stake token and diversifies the stake across different validators. Lido is a DAO that's been formed on Ethereum basically last year, with the goal there to basically allow anyone to stake ETH that has less than 32 ETH. Since in ETH you have this 32 ETH limit. And then also in Ethereum, the problem is that since the merge, so that there's like this transition from proof of work to proof of stake on Ethereum, where until proof of work, until the proof of stake chain is fully live, you actually cannot withdraw your rewards or your stake back from the new chain, since it's all on the new chain. So the old chain has kind of not access to it. Lido on Ethereum kind of alleviates that problem, since the staking still happens on the Ethereum 1 chain, and you can, as a normal user, basically trade on the secondary market your liquid stake token instead of just like having to wait for the new chain. So that solved the big user problem on Ethereum. That was super successful, but it also, this problem exists in a minor form on other networks too. So for example, on Solana, we have this 3-day deactivation period. On Cosmos, you might have 21 days and so on. So on Solana, what we do is you're able to basically just deposit. Oh, I'm seeing a warning. Am I fine? Is it breaking up or?
No, all good, all good.
Okay, perfect. So yeah, on Solana, what we allow you to do is basically you deposit SOL into the Lido through the Lido front end, through the Lido program. The Lido program issues you stSOL in kind of relation to how much SOL you have deposited. So the Lido program contains a lot of SOL that it stakes with different validators and that accrue rewards. And the stSOL basically is just a like representation of how much you have in the Lido program. And then the SOL that are in the Lido program are distributed across currently 15 validators that start to like evenly distributed, and they start to earn the STs like SOL rewards, and that increases basically that pool automatically. So your stSOL are kind of continuously worth more SOL, and you can still use that stSOL since it's basically just another token in the DeFi applications that integrate stSOL. So currently, I'm going to actually talk about like what these applications are and what we're working on there. But the core concept is that, right, your tokens are staking and they're diversified stake, and you still have that kind of representation token that allows you to participate in DeFi. Now, I just wanted to like kind of show a quick demo how easy it is to stake. So I'm now, actually this is the Ether version. I'm here on the Solana front end for Lido. I can just connect my wallet. So I'm going to use Phantom. I have, sorry, one second. I have like the test wallet here that I can just connect. It has a little bit of SOL, right? It already shows me I already kind of staked a little bit because I did this demo a few times already. I can just like, because on Solana also the fees are very low, so this is fun to do. Let's say I just want to stake 0.05 SOL. It shows me I will get a little bit less stSOL since, as I said, stSOL kind of accrues the value of the SOL rewards. So you actually get less stSOL, but when you redeem stSOL, you actually get more SOL out, right? So there's this relationship, there's this exchange rate that's also displayed here. There's a fee, there's like some other info, like how much you stake there right now. So currently around 150 million. And you know, when I press submit, it's just like one transaction. Shows me again, I will lose this token, get this other one. I'll approve it, right? Nice on Solana, nice and easy, relatively quick. We'll have to wait a few transaction like confirmations from the blocks. I can actually look on the block explorer, maybe how it looks there. I guess maybe I can actually go continue. Or maybe let's see. All right, it's a successfully staked, right? So it increased my balance by the 0.05. If you want to just see the transaction on the amazing Solana Beach Explorer, shout out again to Robert and Staking Facilities for building that. You can see like a bunch of instructions that are very hard to understand, but that's essentially the transaction happening, right? So it's quite easy. And now if I look in my Phantom, I can see, again, I have some more of the Lido staked SOL. And you can also see it here. All right, let's continue just basically on the integration. So right now, as I said, like the main use is that now you can use your stake tokens also in DeFi. Of course, Solana DeFi has been like growing since, I'm sure today you've already talked about this, but basically like right since the summer, it really kickstarted. Before that, DeFi in general actually mostly existed just on Ethereum, right? And maybe early this year, Binance Smart Chain and Polygon came along, were like the first kind of chains, but it's kind of the same that was on Ethereum already because they are also EVM chains. So the DeFi applications that were there are basically just forks of what is on Ethereum. And then Solana is maybe the first chain that has like its own DeFi ecosystem with its own like smart contracts or own DeFi applications. They are also like doing similar things than what is on Ethereum, but it's also like kind of written in Rust. It's a totally different environment. And you know, really this kickstarting here is a lot also liquid staking. So this is us, this is Marinate, this is some other staking pools that then basically unlock SOL as a collateral for other applications. Since a lot of people want to keep earning their 7% staking yield on Solana, but also want to participate in DeFi. So really, it's been growing to like 12 billion right now. A lot of this is like decentralized exchanges and also liquid staking. So I just want to kind of show this. Right now, we with Lido, the most of the integrations we have are with kind of automated market makers or decentralized exchanges. So it's Radium, Saber, Orca, Mercurial, and Serum. So that allows you to, if you are a stSOL holder, you can provide liquidity in these pools, which usually have like one other asset in them. So if you're like bullish on both of these assets in the pool, you can provide liquidity and earn like extra yields from the trading fees that accrue in these pools, or basically additional bootstrapping incentives that are given by these DEXs and also by LDO, the Lido token, that we actually bridge from Ethereum. So that's story maybe for another day how that all goes. But basically, Lido is one of the first protocols that actually goes across chain in reality. And I think that's pretty cool, right? Like it's been still very early for cross-chain applications, but we try to really do it in as decentralized as possible, and used, for example, the wormhole bridge. It's also a very amazing product that helps you bridge between Ethereum, Solana, and also Binance Smart Chain, and soon also Terra. And yeah, with Terra, for example, like one integration that Lido has on Ethereum is with Anchor protocol, that's lending, borrowing. That's also something we're working on with Solana right now. So right, the first step was kind of this liquidity. Now it's about like also allowing people to take out loans and maybe borrow their stSOL. Yeah, I just wanted to kind of show the pools that exist right now. So we have, for example, a stSOL Solana pool. So if you have stSOL, your stSOL is earning the rewards, and you can add like 50% SOL, and you would earn 20%, for example, here right now in this pool on Mercurial. And that's right here is the saver pool that has a little bit less APY. What it allows you to do really is, if you have both of these assets, you can basically benefit also from the trading that happens between the assets and from the incentives, as I mentioned. The pool on Mercurial is actually super cool because it also takes into account that stSOL is value accruing. So as the staking rewards are earned, the pool is actually updated so that it is actually like super stable and efficient to swap here between these assets. And you, as a liquidity provider, you don't have impermanent loss. If that's says something to you, I probably can't go into explaining that right now. But maybe the last integration I want to highlight is the this one. So this is actually super cool, since this is the other Lido asset on Ethereum. So the liquid staked Ether asset on Ethereum that accrues the Ethereum staking rewards, plus the staked SOL that accrues the SOL staking rewards in one liquidity provider pool. So essentially, we bridge the staked Ether from Ethereum to Solana, and you can provide liquidity to both of them, and both of them will be earning staking rewards. And you actually get also this pretty high still APY in Orca and LDO. So it's like kind of, I think, first of its kind, like it's two liquid staking assets in one pool. And yeah, pretty proud of that one. It's been a lot of work with all these teams and using Wormhole. You maybe can imagine how much that has taken, but it's really cool to see like this composability that kind of DeFi is all about, right? Also working across chains, and maybe like it gives you a hint of what is to come in the future, I guess. Yeah, I think that's it from my slides. I hope that was somewhat interesting or helpful. Let me know if there's any questions there.
Love your energy, and thanks for doing that for like during your holidays. So thank you very much. Highly appreciate it. Question: what actually drives the high yields in these DeFi protocols? Like, for example, the ones that you showed. Is it because it's new industry adoption and protocols are paying just to subsidize customer acquisition, or what is behind it?
Yeah, definitely a lot of that. Yeah, so I think right now most of the DeFi yield is coming from basically protocols rewarding the users. So right, liquidity is very much mercenary also in a way, where everyone that has an asset is looking for how to deploy it best, and who can like provide incentives will get the liquidity. So it's kind of given that you have to do this. And also, right, like the idea is that I think for most of these protocols, the yield will ride it once it hits a certain point. And also there's a lot of trading happening, right? If you establish yourself as a decentralized exchange, which is happening more and more, right? Like the trading from swaps actually can generate a pretty high yield too for the liquidity providers. And then as the other incentives phase out, the kind of usage fees can take over. It's similar as in proof of stake right now, where like most of the actual rewards for the validators come from token inflation, but of course, in the long run, the idea is that like applications that run on these chains generate fees, and those fees go to the validators, and you need less of this new bootstrapping mechanism. So I guess really yield farming everything is just a means to like, yeah, acquire users to bootstrap a new economy, right? In the end, we're building a new kind of decentralized economy, and it might sound like, you know, it's often like kind of, yeah, I don't know, it is what it is. It's working, it's incentives at play, I guess. It's game theory, and a lot of it is also like hoping that these fees will someday come in, right? But I think in general, we have proven with Ethereum or like Uniswap that it can work. Like Ethereum is generating millions of dollars in fees a day right now in proof of work, and Uniswap or like some of the dexes too. So if you imagine that like more and more of the world economy would run on these things, then it's not too hard to imagine that you actually don't need these early incentives anymore. So right now, yes, a lot of it comes from this bootstrapping incentives, let's call them that.
Yeah. Could you share with us what is the concept of staking economy? What do you mean when you say the staking economy?
Yeah, so like the news that I guess in general, there is an industry of people that work on proof of stake blockchains. So I guess that's on one side, like the validators, right, that run the nodes, or just people participating by staking their tokens. But also, I guess, in some sense, the networks themselves, right? Like, I guess the staking economy for me is just a kind of overarching term for that part of the crypto ecosystem where we either like work on like the infrastructure side or kind of like using the tokens. I guess it could be something that the DeFi is maybe another word that is kind of like that, but you know, also liquid staking in a way kind of brings these two together. That's what I like to highlight about it, right? Where before in 2020, so when we were like working on staking in 2018 to 20, it was like a separate thing where you would be like just securing these chains and like looking at new chains. There were no applications on these chains yet. It was more just like getting the infrastructure up and ready. And the Ethereum had DeFi, and now, you know, it's all coming together. So I guess staking economy is just trying to like say, look, that's this part of the industry right now where it's probably like a few hundred or even not even 100, probably tens of companies kind of working on this infrastructure. And then of course the people that hold the tokens that stake, I think also belong to it, right?
Yeah, everybody contributes or is able to contribute. And now with liquid staking, even contributing, like you don't even have to decide anymore if you put your assets into securing the blockchain or if you provide liquidity to the market. Quite interesting. I want to ask the audience. I mean, I see Justin is still here, Ellie is still here. Any questions to Felix?
Hi. Thank you so much for being here and for providing all this information. I guess when I look at Chorus One and I see that you're supporting 25 networks, basically all, why pushing for Solana? Like, why Solana in your opinion? I see it on the website, like Lido for Solana. Why is Solana out of the 25 places you're staking? I guess where you're putting the push.
Yeah, that's a good question. Yeah, I think, you know, we saw, so we've been thinking about this liquid staking idea for a while. So when we started on Cosmos, like a lot of the networks we started on are Cosmos networks, and there's this 21-day unbonding period, and many people were always unhappy about that, or like trying to figure out how can we work it out. And we actually worked out a prototype there for that, even or anything was a thing. And then it just happened that, you know, Ethereum, Lido was a big success. We were like, okay, we should also build like an actual product on this. And we're just very close to the Solana team. We knew this is going places. We knew there's DeFi emerging there. And we basically figured out with the Lido DAO that this should be the target for us to work on a solution. And we did it. So we also wanted to give something back to the Solana ecosystem. Of course, we've also benefited a lot, right? We're the #1 validator now at Solana. We're kind of like also trying to disrupt ourselves a little bit, doing our part in like making it more decentralized by Lido staking with 15 validators, right? And evenly, and like if you would stake with us, we're also moving, like trying to move certain stake from us to that, which can also take a little bit, since many of the larger institutional holders or other people are a little bit more risk averse and have to like have certain things in place to use like some products like this. But in general, we see a lot of potential here, and we love the Solana ecosystem and people, so we just decided to start there or work on that right now. So we're also working on a bunch of other things, but this is one of the core.
Can you share more about the personal connection with Solana? I think it's always interesting to understand how these things, we're still at a very human phase, right? And so like you said, you know them, there's a level of trust. Like, how did that happen?
Yeah, I mean, we just like in 2019, there is not a lot of people that are interested in these things, or 2018. And we basically, you know, it was our job to find these new proof of stake chains, since this was our company focus. And we found Solana, we spoke to the team. We're very excited about what they're building. Like a lot of our engineers love to be back then. We met the team at like some of the conferences back then, and you know, just got along pretty well, and it's all gone from there to this basically. So like now it's been going really crazy, right? Even we don't see that much of it, but yeah, that's it. It goes just far back.
And maybe one last question, like, or I don't want to, I'm sure other people have other questions, but I'm wondering, like, here I would be going, if I would stake on Solana through you guys, basically, you are my middleman, you are my intermediary that I have to trust, right? Or so basically, even though you say on the slide, you know, it's decentralized, basically you are the centralized party here providing the staking, correct? And why would I go through you guys if I can do it on my own? Are you catering towards institutional parties?
Yeah, so multiple facets on this one. I think so. We're not really a middleman. We like basically provide the staking service. So it's really, you're still in custody of the keys. You're still, have your access to your money. We don't have any access to that. We basically just run the server infrastructure with a high availability and do that for you or for other people that don't want to do that, which especially in Solana is a very high hardware requirement even now, but it will also grow in the future probably more, as this is basically how Solana scales, or how it's able to be so fast, is that you actually need a kind of beefy machine to do it. So it's that already is kind of a barrier.
Yeah, that's what Justin was mentioning earlier, is that's a barrier to decentralization, is the high beefy computer needed to be able to do this. Therefore, your service, it makes sense, because it's hard for me to just buy a beefy computer just to do that, correct?
Yeah, that's one part of it. There's like a lot of other factors that play there. I think it's also just the time, right? No one wants to sit and watch their computer 24 hours, see if it's there, and like you go on vacation, it goes down, you're losing actual money. So that's like what we guys are doing, right? Like, you also don't run your website on your home server. I mean, a few people do, but like most people don't, you know?
Justin mentioned earlier that there was a block subsidy going on this year, but that currently running Solana nodes is at a loss. Is that a loss that you're covering, or is that something you're experimenting at all?
Yeah, so I mean, this is probably referring to kind of the delegation program that the foundation has, where you get like some SOL stake from them. And that is actually not enough basically to cover, because in Solana, that's just like the whole thing where the transaction, the consensus votes are also transactions. So they cost fees. And these fees are basically too high if you don't have enough stake. At a certain point, you break even. We actually did a big analysis on this, which we're probably also going to release soon on the forum. So basically, you need a certain amount of stake. And if you don't hit that, you can't be profitable anyway. So it definitely has a pretty high barrier of entry.
Yeah.
Just based on that.
Yeah.
I suspect my estimate was way too low. 80,000 stake.
Yeah.
I suspect it's a lot higher. It's probably in the millions. No,
it's in the, so dollar wise, we are. It's somewhere like in my, like we did it based on kind of a little bit hardware cost, bit of vote costs, and it should be around like 5, 6 million, 7 million. Yeah.
Yeah,
something like
my estimate was just way too conservative. I saw those numbers, but I agreed to do this on short notice and I couldn't find the source in time. So I just did a really cheap calculation. I was way off, 5 to 6.
Yeah, I
That's,
think
that's
Whoa.
I
nuts.
think it's
That's going to
also
get worse, right? As the subsidy decreases.
yeah, I think right now, I mean, yeah, there's a bit of a question why they actually made these transactions kind of normal transactions, since you could just have them included always, and then that would fall away and it would be much cheaper. But that's like not how it is implemented. I guess there is a lot of
Well, that's exactly the
problem to change that.
example of what I was giving before. It's an example of a design feature that makes it look good to ignorant investors, and it's bad for blockchain design, right? Like, why make that choice that way? You know?
Yeah, it's definitely like misleading, right? You see like these transactions per second, and actually a lot of them are just these consensus votes, which obviously is not what you want to see. So sometimes if you like don't really see, but I mean, yeah, like all I can say is that I guess this is also based on that was just kind of easier to build it like this in a way, where it seems to make sense at the start, and maybe they found out, like we all basically found out, that this is a problem
I mean,
in the
Tezos did
last
the
few
same
months, and
thing
now
years
it's
ago.
very hard to change it. Yeah, I know. Yeah, I mean,
Yeah.
a few people have like
Right, guys.
there's some design choices that like some chains make, and they don't learn from each other. Some people
Yeah.
try to, and then they miss something else. It's like a super complex thing, right? And it gets super hard to change.
Yeah, guys,
Yeah.
all of us who run businesses, have daily operations, do strategic choices, and are in a period of a bullish market, you know, we kind of know we are human beings, and sometimes human beings don't make the most smartest choices under like under given circumstances. I think it's time to say thank you to Felix, and thank you to Ellie, thank you to Justin, or whoever, everybody in the audience who drove the decisions. It would be great, like just sign up for the newsletter, Staking Economy. I read it with a lot of joy, because it gives a perspective on how every one of us can contribute to with our assets, with our intelligence, with our works, to building that economy. So well, thank you very much, Felix, for sharing your product innovations with us, and I look forward to reading that report that you talked about.